India Inc.'s revenue is up, but not much. Corporate revenue increased about 5 to 6% in the Jan to March quarter of fiscal 2024-25, thanks to improved showings by consumer-driven sectors, apart from staples, that is, according to a report released by Crisil Intelligence over the weekend. For the full year, that's 24-25, overall revenue growth is estimated at about 5%. That's lower than previous years, and we'll hear more about that, and lower than the average as well. Now, this is based on an analysis of 400 plus companies that account for about half the market capitalization of the National Stock Exchange, though the final results, which could be over 750 companies or thereabouts, is unlikely to change the picture much. Crisil has also taken note of the tariff move, saying that affected countries could retaliate, which could lead to excess supply landing in countries like India. So expect volatile commodity prices, and eventually we'll have to see where tariff prices or tariffs eventually settle. And the tariff shock will obviously add to the uncertainty. Now, all of this means that India Inc. is continuing to put investments on hold, at least in the short term. I spoke with Pushan Sharma, director of Crisil Intelligence and author or one of the authors of this report. And I began by asking him what were the key takeaways from this first cut of data, what was standing out, and more importantly, his outlook.
Looking at the sample of 400 plus listed entities, what we can see is that the corporate revenue for the sample set has increased by about 5 to 6% on year during January to March quarter. And this is at pace with the preceding quarter. And this is being supported by improved showing by the consumer-driven sectors, excluding the staples. And it is being weighed down by sectors which are linked to exports, construction, and industrial commodities. The growth on quarter-on-quarter basis is also expected to be around 5%. And if we look at the full fiscal for fiscal 25, that too is converging around 5%. So most of these numbers you can see are around the 5% level. And now, if we talk about the margins, we're seeing that the overall EBITDA in Q4 has grown by about 8% and taking the overall margins to about 21.1%, which is about a 50 basis point improvement YOY.
Okay, that's for the full year.
50 basis point is for Q4.
Have you looked at over the full year as well, 23-24, 24-25 versus 23-24?
If you look at fiscal 2025, the margins are expected to be around 21.5%, which would be about 80 basis points better than last year.
Overall growth for the full year again is 5%.
Is 5%. So most of the revenue numbers are converging around 5%.
And how would this compare to previous years, let's say 2021 versus 1920, or let's say before COVID or 2 years after COVID?
Right. So if we look at, say, from fiscal 22, we saw revenue growth of around 27%. Fiscal 23, we saw growth of around 19%. Here, of course, one has to note that these were on a slight low base of the COVID year of fiscal 21. Fiscal 24, we saw this number at 3%. And now it's at about 5%. So slight improvement compared to fiscal 24, but much below the typical averages we've been seeing over the years.
And when you say average, what would that average be? Because this 26-27%, I'm also assuming is a slight aberration.
Right. So the average would be close to about 8 to 9%.
And that's, let's say, the average of India in growth, whether it's for this sample or even for a larger sample.
That's right.
Can you tell me how this is looking when you break it up? I mean, is there an 80-20 principle working here or similar?
So something on similar lines, I wouldn't say 80-20, but what our analysis shows is it's a story of 1/3 versus 2/3. 1/3 which is performing better than the average and 2/3 which is actually weighing it down. And now when we dwell deeper into these two parts, what we see is that the 1/3 is being driven by segments which are consumer discretionary products and services, consumer staple services like hospitals, and some agriculture-linked sectors like fertilizer. Now, consumer discretionary products and services, these account for about 1/4 of our entire sample set by revenue. And within this, we're seeing that the consumer discretionary services are performing much better than the products. We're seeing mid-teen level of growth in the consumer discretionary services such as airline, telecom, and hotels. Telecom in particular is benefiting from tariff hikes that have been taken by players last July, as well as transition to 5G, which has better realizations. Airline, on the other hand, is benefiting from higher airfares. Now, when we come to consumer discretionary products, automobile being a large chunk of it, Here we're seeing growth is in the mid-single digits, whereas organized retail is growing at a much faster pace at around 17% because of groceries and other such segments. Coming to consumer staple services, which is something like hospitals, here we're seeing steady growth of around 13%, which was recorded in Q4 of fiscal 25. And finally, on the agri side, with crop prices having been firm last year, we can see premiumization on the fertilizer side, farmers moving to premium chemicals, and the revenue here has increased by about 18%. So that's on the one third that has done well. But if you look at the two-third that's actually weighing things down, here we see segments such as consumer staples dominated by FMCG, exports dominated by IT, construction and investment linked sectors, and industrial commodities. And if you look at the FMCG, we're seeing tepid growth in low single digits. There's pressure coming to the two-third of the revenue side, which is weighing down the overall revenue growth. There are segments like consumer staples dominated by FMCG, export dominated by IT, construction and investment linked sectors, and industrial commodities. Now, if you look at consumer staples, FMCG forms a large part of it, like I mentioned. Here we're seeing low single digit growth. And the pressure is across categories, right from personal care to beauty, and relatively lower in the food segment. However, if one looks closely at this segment, we see that the home care segment has seen high single digit volume growth, unlike the overall FMCG pack. And that is evident from HUL's results as well. And here we're seeing that sales of liquid based detergents and dishwashers are doing well. Now, what this points to is that the discretionary segment within FMCG is also doing well. And what that indicates is that the upper middle class, they are still participating in a big way in consumption, and there's pressure in the lower segments across the board.
When you say things like liquid-based detergents, you're classifying them as discretionary within FMCG.
Broadly, see, FMCG we classify under consumer staples, but has a host of segments. So while it is still classified as staples just from a definition point of view, but there are some discretionary parts to that. Like for example, a liquid detergent we would still call it discretionary.
But that would mean that people buy it only on occasion, right? I mean, not frequently.
No, now the market is moving towards the premium side on home care. So rather than powders and the bars, people are moving towards liquid-based detergents and dishwashers, which is why I'm classifying that as discretionary.
And you were talking about exports.
Right. So coming to exports, the heavyweight here is the IT services segment, and that's clocked around just 2% growth in Q4, with only a marginal pickup in demand. On the other hand, on the export side, pharmaceuticals have performed much better at around 8%. Now, coming to construction-linked sectors, here companies pure play into construction are doing well at growing by about 8%, but we're seeing subdued growth in the heavyweights in this category, which are cement and steel, and that's largely linked to the price pressure. In case of cement, it is because of high level of competitiveness. In case of steel, it's because of the low price imports coming in from China. And finally, going to the last two segments in this two-third, which is investment linked. Here we are seeing that the power generation revenue growth is quite tepid. And in case of industrial commodities, coal is the heavyweight, and we're seeing that has grown by just about 1%, and that's due to fallen e-auction premiums. So that's a summary of the entire, sectors across corporate India. A mixed bag. Consumption sectors, largely on the discretionary side, doing well. Pressure on the industrial construction commodity side.
And if I were to add it up, so construction linked is your top vertical with about 24%, consumer discretionary 20%, and export linked is 21%. So about 65%, or rather 66%, is really these three areas. That's construction, followed by exports, followed by consumer discretionary. Am I right?
So this adds up to, so if you look at construction, export, and you said the other one you mentioned is consumer discretionary. So consumer discretionary, I wouldn't classify under the same bucket because consumer discretionary is actually doing well. These represent about 51% of our sample side. Construction, export, and consumer discretionary services. If I add consumer discretionary products, then it crosses about 70%.
What's your final sample size like, Pushan?
So the final sample would be closer to about 750. Right now, we're at about 400.
You said you're halfway in terms of market capitalization. Could the picture change dramatically?
Not substantially, because most of the leaders have come out with their results. It's well spread out across these sectors. So it may not change substantially, only a tad bit here and there.
And any other takeaways at this point from the whole year, which is 24, 25, and also your outlook at this point?
Like we were discussing earlier, the whole year we're looking at revenue growth of around 5%. It's a tad bit lower than the averages that we see typically. There is definitely pressure on some of the commodity linked sectors on account of pricing, and also pressure on some of the staples like FMCG on the volume side. Coming to the growth that we expect for next year, we're looking at a growth of about 7% in fiscal 26. And the growth is expected to be driven by some of the sectors which have underperformed this year, like FMCG, also driven by some sectors that are performing well, like airlines, telecom, as well as hotels. Now, what is going to aid this growth? We see that there is some benefit that we will get out of the revised tax slabs that have been announced in this budget. That is expected to put about 80,000 extra cash in hand for a person earning a salary of about 12 lakhs per annum. This, along with increase reduction in the interest rates by about 50 basis points that have been announced this year by RBI, once that gets transmitted into actual lending rates, we expect that is going to aid growth. On the rural side, we have a forecast for an above normal monsoon. There's a caveat there. Right now, the forecast is for 105% above normal, but there is also a probability that they have associated that it can actually go above 110%, and there's probably a probability of around 26% associated with that. If that happens, then things could change. But now, considering 105% above normal monsoon, rural growth could also be supported for the Kharif as well as the Rabi season. So these are factors that should aid growth, and we're expecting some volume-driven growth because the commodity prices are expected to be still under pressure.
Pushan, thank you so much for joining me.